This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to 30 Deals in 30 Days. We are on day 13. If you have not joined the challenge, we are underwriting commercial real estate every day, 30 days in a row. I'm using my spreadsheet, which you can get for free if you join the challenge. The link is in the description below. And you guys are seeing in real time how I would go about doing some back of napkin math, underwriting some of these deals. Today's deal, let's go ahead and dive on into it, is from Chad. He dropped this in the 30 Deals, 30 Days chat. He said, "Hi, Tyler. Love your channel, and I've learned a lot." Glad to hear it, Chad. Appreciate that. Says, "I've owned residential real estate for several years, but looking to exit residential and do a 1031 into my first CRE deal." We have done a ton of that at the Cauble Group. That's largely what we kind of specialized in, was going out and finding these residential real estate investors at real estate investment meetups, convincing them to see the light and getting them into commercial real estate. We've made some lives better because of that, I think. I recently moved across the country and basically have to rebuild my connections, brokers, lenders, contractors, property managers, etc., in my new area from scratch. I'm looking at various listings, and your day 12 example really helped me for those types of deals. A broker sent me the below listing, and I would be curious to see how you would analyze the deal. The OM states that some cap improvements, new furnaces, paint, lighting, fencing, roof upgrades, updated bathrooms were recently made to the property. Doesn't seem to be triple net based on the annual rent versus NOI. All right, let's go ahead and dive in on this one and see what we are looking at today. Looks like this one's up in Indy. We've got a Bow Truss building. I love Bow Truss roofs. I bought a building here in Nashville this spring that has a Bow Truss roof. It just looks beautiful. All right. Does look like the exterior has been updated. The parking lot's still pretty rough. That's not the worst thing in the world, depending on how the rest of the market is. But that's probably one of the first things that I would add to my list is how can we make this parking lot look really nice? I never like how parking lots just spill over into the street. In fact, let me show you what I did with one of those one time. 4015 Travis Drive. This is a bit of a tangent, I know. But I'm going to show you exactly how I fixed that. This building right here had a parking lot that spilled out into the street, and we just put a little island right there. See, that's it. Pretty simple. Little island, curb, some gravel in there, and some trees. Relatively low maintenance, but at least it breaks it up. You know, you're not just spilling out into the parking lot. Relatively inexpensive way to at least break those up, right? In my opinion. I love doing that. Jam is saying, great to be back. Jam, great to see you again. Thanks for joining us as always. And let's see. M is saying, hello from New York City. Guys, don't forget to like the page. I agree. Guys, give us a like. If you're enjoying this, let me know it. Okay. Getting back to this, roof looks like it's in really good condition. Just from what I can see right here, looks like you've got several roof penetrations. We'd want to take a look at that for sure. Okay. Looks like that might be boarded up. I can't really tell what's going on there. Oh, let's see. All right. So you've got a fenced-in parking lot to the side as well. All right. Pretty flex on the inside. Pono is saying, what was the cost for the curb? That's a great question, Pono. Man, I did that project back in 2019. So even if I had the price right off the top of my head, I got to be honest with you, it'd probably be 2 to 3 times that today, just with how expensive everything's gotten. I can't imagine it was more than $3 or $4K, maybe $5K to do all of that, including like the trees and landscaping and everything. Because we did it pretty simple. We built the curb. We dropped all the dirt. Ripped out some of the asphalt, dropped all the dirt in, put the plants in, put some rocks on top of it. Relatively simple. All right. Interior looks relatively nice. Yeah, this does look like it's just boarded up. Like that just looks like OSB, which, never a good sign when the garage door is missing and it just has wood panels in front of it. Looks like a relatively busy, potentially intersection. Getting at the map. Okay. Unfortunately, that's not going to tell me a lot. So what I'm going to do, 10,000 square feet, $79.50 a foot. I like that. I mean, look, right off the bat, I don't have my phone on me because it's charging in the other room. But I mean, $79.50 a foot. If we wanted a 10% cap rate on this deal and we didn't have to spend any money to fix it up, we need to be able to rent it for, just move the decimal over, $7.95 a foot triple net, right? That's at a 10% cap rate. So since this property is being offered at about a 10% cap rate, that's what I would expect those rents to currently be at, which is a good sign, right? That's kind of what I would like to see. All right, let's go look at this address. Okay, so Kentucky Avenue does look like a pretty busy street. Right off the side. Okay, hey, man, across the street from Pizza Hut. What's going on? High maintenance diesel. Looks like it's one of the tenants. That I always like this. Look up the tenants' reviews. 27 reviews, 4.9 stars. That's really good. That means that tenant actually cares about their business. That's important, especially when you're checking like local credit tenants, right? And local credit just means it's a small business from that area, right? They're not going to be a Pizza Hut, right? They could have a bunch of franchisees or multiple locations. So the fact that they are highly rated is really good. We like that. Means that they're probably going to have some good business for a long, long time. That's what we're hoping for. All right, looks like we're not too far from the airport. Ooh, I like that. In a flex building. Not too far from the interstate. Halfway between the airport and downtown Indianapolis. Not a bad location. All right. And it looks like we're kind of in a semi-residential area. I mean, there's some, industrial stuff all around us, but for the most part, these are mostly neighborhoods. A little golf course over here. That's kind of nice. Looks like you got a little kind of your major shopping center right down the road. It's good. I mean, it seems like a pretty decent location. All right, the thing that I like about this is that if you come in here, you see that Kroger's here, right? Kroger spends a lot of time and money making sure that they put stores in the right locations, right, for a good demographic. So, I always like to follow Chick-fil-A's or follow Starbucks because they're spending a lot of money on site selection. So keep that in mind. Whenever you're buying commercial real estate, what other big tenants, national tenants are around you because they have big real estate teams that spend a lot of money on that. Z is saying only 4 minutes late. Hey, Z, you're just in time in my heart. Jam is saying, what do you think about buying or building malls? I think if you could buy a mall at a cheap enough price, that it makes a lot of sense. I think building them today, unless you're doing residential above or a hotel above or office space, some sort of mixed use above, I think that the traditional mall is dead. All right. So looking into this property, let's see what else we've got. 10,000 square feet, fully leased to 2 tenants on new leases as of 2025. All right. Oof. I don't know that I want to give him my information yet. Because Wade, if he's a good broker, is going to be calling me. All right, clear ceiling height, 12 feet. That's pretty low. That's basically office space, right? 12 feet's not going to get you much. It's not terrible, but usually what you want to see is 18 to 20. There we go. Here's the free flyer. That's what we like. All right, so you've got 10,000 square feet on 0.75 acres, so not really any room for you to build anything else. Typically, what I tell people, especially when it comes to flex, you're looking at about 10,000 square foot building per acre is essentially what you can do. All right. Recent capital improvements, new furnace, exterior, interior paint, LED lighting, exterior fencing, roof upgrades, Oh, notice how they didn't say roof replacement, roof upgrades, updated bathrooms. I would want to know what the roof upgrades are. Did they just patch it? Did they just roll some sealer on it? What does that actually mean? Okay. High maintenance diesel is taking up 50%. Wow. Look at the difference in these leases. One's at $11, one's at $7.20. I wonder why that is, because they were signed at the same time. Maybe high maintenance had some improvements made to the interior of their space, and that's why. Okay. So that puts us really kind of right at that, I don't know, $8-9 a foot blended rate. Also, notice the lease terms. Look at that. One goes 5 years. One is a single year. So not the worst, right? Look at that. You actually have the opportunity to raise this rent to probably $11 a foot, right? So we'll keep that in mind when we underwrite it. You have a pretty good opportunity there. I actually like that, because a year, it gives us enough time to get in there, stabilize, like wrap our arms around the property for 6 months, and then list that space and get it leased within 6 months, right? You got plenty of time. See is saying, and they just use super glue and call it an upgrade. Yeah, you never know. You never know sometimes, man. I've seen some crazy things inside some of these spaces. In fact, this space that I'm in right now, when I bought this building, there was a dude living in here doing some, let's just say we had to have a hazardous material crew come in to the closet. He didn't like to go down the hall to go to the bathroom, which is just crazy to me. It's an office. This is an office building, like a 30,000 square foot, 3-story office building. Crazy. That's probably too much information. Sorry, guys. But hey, that's part of it, man. When you're dealing in commercial real estate, you never know what you're going to find. This dude would smoke cigarettes. I know it's a tangent, and I'm sorry, but I think it's a very funny story. This dude would smoke cigarettes in here, and every time I would come on site, whenever we were doing due diligence, I would ask him, I'm like, who is smoking cigarettes in this building? He'd be like, I don't know. I think it's one of the tenants upstairs. Like, yeah, it was him. Like, scratchy voice and all. It looks like they might have just put down a new layer on top of the roof, in which case, hey, it's still practically a new roof. Zia's saying, I hope you got a big discount on that. I actually kind of did. We came into it with a valuation of about $2.2 million. And I think today, this building, keep in mind, this is 2019. I think today the building's worth over $5 million. So we did pretty well. On this one. All right. I think I kind of have everything that I need to know. I like this one. This is a great one to underwrite because we haven't underwritten anything like this before. We've done a few flex buildings, but not one that that's like fully stabilized. 1 year in, we can have 3, 4, 5 months of vacancy. I'm going to have to go back and see what the actual vacancy looks like in Indianapolis. And then we lease it back up for a higher rate, which would be very exciting to see. So I'll show you guys how to do that. Let's see. How many square feet is this building again? Straight at 10,000. We like that. Makes it easy. Zoom in so you guys can see a little bit more. All right, 10,000 feet. They're asking $795. I don't have to bring any rehab to the table. They're already finished out. Now, what I will probably do, although I would likely do this out of cash flow if I was actually going to do this, is I'll bring some money to make some tenant improvements in the other space, probably $5 a foot, right? For 5,000 square feet. So that's 25 grand, right? We'll do paint, maybe some new floor, whatever that ends up being. All right. Total closing costs, we'll drop those down to 20,000. Puts us at 2.44. Down payment, let's put down 25%. We'll probably get let's say 6.75% interest rate because we've got 2 tenants in place, one pretty stabilized. It's got really good Google reviews. I would bring that up to your lenders, by the way. And let's see, we've got what did I say the blended rate was? It's 11 plus 720. All right, so 18.2 divided by 2 gives us 9.1. All right. So $9.10 is where we're going to start off. All right. Now, we'll keep our rent increases at 3% per year. All right. And then over here in the vacancy, remember this first full year, we're going to hit that. Second year, I'm actually going to say, let's start off with 50% vacancy. Because we'll be vacant for 6 months, and then I'm going to get a tenant signed, right? So that's how I'm accounting for that in our vacancy rate. Now, here's the thing. After this year, I am going to have to change this rate. So what I'm going to do is I'm going to say we're going to average $11 a foot. So I'm just going to put $11 right there. And then if you look at this formula right here, it's basically just, it says D35 times 1. Oh, I see what it's doing. So I'm calculating, so it's off of F10. This equals, whoops. Let me delete that. Gross potential rent. I'm going to do it right here. All right, this equals this times F10, which is our square footage. It's not going to be a percent. So that puts us at $110,000 a year. So what I'm going to do is I'm actually going to overwrite this and say $110,000 because that's our new rent once we've got this other tenant in here. And then I'm going to mark that as red so that I know I changed that box, right? That formula has been changed, all right? This will be cool to see how this changes the returns on this deal. It'll be really interesting. All right, let's come down here. Let's see if we can tell what type of leases they are. So they're saying that it is a 9.47% cap rate on 795. So let's do this. 795 times 0.0947 gives us 75,286. So we've got some expenses in here. And I'm going to actually take that and I'm going to subtract our supposed NOI, which is $90,999. $90,999. And that gives us $15,712. So we have $15,712 in operating expenses per year. I don't know. It looks like that's basically let's call it $1.50 a foot. All right. So we don't know exactly what those are. They don't tell us in the offering memorandum, but I can just tell that, based on the cap rate of the property and what it's saying the actual cash flow is, right? Because the cap rate here is saying it's a 9.47% cap rate, but here we're saying we get annual rent of $90,999. So there's obviously something that we're paying. They could be modified gross leases. I don't know. So we will pay 6% commissions. Why is this negative? Oh, I haven't had that problem happen before in the spreadsheet. So what we will do is we will actually zero this out and turn it red. So if you see obviously negative commissions, you're not just going to get paid for having too much vacancy compared to the year before. The way the formula works, you're just going to have to zero that out. So if you ever see commissions shown as negative, zero it out. All right. And our annual expenses will continue to increase at 103%. Jam is saying, I had very angry tenants leave a lot of not fun things and everything else they could think of behind. Yeah. I mean, look, not as common in commercial real estate, far more common in residential. I won't touch all of that kind of stuff. Game Master saying live in effect. Absolutely. Kevin, a lighter red today. Yeah, you know what? I'm feeling a little bit softer on the reds. So I'm not being as aggressive about it. Yeah, Game Master, we don't like negative numbers. Sometimes we do. Most of the time, yeah, not really good. Not good at all. So, okay. All righty then. So, okay, look at this. How cool is this? 0.82 debt service coverage ratio, 0.7 debt service coverage ratio. Look once we get that new tenant in. 158, 163, 167. That is a great debt service coverage ratio. Remember, we want to be at least 1.25 times. You might be able to find a bank that says, hey, 1.2 times debt service coverage ratio is fine. I like to aim for 1.25. It gives us enough just room there to feel enough cushion to feel really good about it. If you're not familiar with the debt service coverage ratio, it's how many dollars you are bringing in on the revenue side compared to how many dollars you're having to pay in debt, right? So this basically says for every dollar in debt that I have, I'm making $1.58 in revenue, which is great, right? That's where we want it. Let's say that I am going to syndicate this. I know you guys love to see it when we're raising capital and splitting everything up. So we'll do that. We're going to go full term, which means I'm just going to pay principal right off the bat because we've got it stabilized. So we might as well. I'll keep reserves where they are. I think I feel fine about that. We'll do a reallocation of 30%. That means 30% of this is going to you as the general partner. 70% is going to your limited partners for putting cash in the deal. All right? Ooh, look at that. Come on. This is looking like a great deal. Get it up to 7, 8, 9% cash on cash returns for your investors. I doubt we'll get a 7 or 6.75 cap rate. Let's just say we get a 7.25. See how this deal shakes out. We'll keep our net refi and sale proceeds at 93%. The only time that I would ever really change this, right, because it's right now set to pay 6% commissions and 1% in closing costs, is if you did want to refinance it, at which point you would say, well, I would have to leave in 25 or 30%. Let's say it's 30%. Well, then this would become a 70% number, all right? That's how you would account for just a refinance in a 5-year period. So we'll just change that back to 93 for now, all right? So that brings us to a total return of 100%. Oh my gosh, right off the bat, we didn't even have to stress test this deal, and it looks like it's going to work. That means that we are doubling our money over a 5-year period. We're annualizing a 20% cash-on-cash return and a 19.34% internal rate of return. Now, the caveat, the big caveat that we haven't looked at yet is, can we actually get this leased up? Can we actually get this leased up in 6 months at $11 a foot? Just because we have one tenant there that's paying that doesn't mean that that's necessarily the case, all right? This could be a sale leaseback situation, right? Maybe the diesel group is the one that is paying. They're the ones selling the building. So, of course, they're going to be incentivized to have a higher interest rate. Kevin is saying, Tyler, check your formula for operating capital. The one I downloaded adds in the year 3 total expenses, but I don't know if that's supposed to happen. Does that happen in the spreadsheet? It does. Yeah, so what it does, like the operating capital, you'll see here. Operating capital is saying 21,308, all right? So if I double click that, it'll highlight all the cells. So it'll say, here's your debt service. Let's see what else. It looks at your operating expenses if you have a shortfall. This one, it doesn't seem to have a shortfall. So basically, I think what it's saying is just bring a few months of operating capital to the table to make sure that you have enough cash on hand. You can always delete that. You could always just overwrite this to bring in however much capital you actually want. But basically, like when you'll start to see this operating capital piece get big is when we have like a negative number in our non-operating expenses or our operating expenses, all right? Because it's going to say, like the way that the spreadsheet looks at it is it goes, it looks like you have a monetary shortfall in the first year that cash flow isn't going to cover. You need to bring that cash to the table. So that's how that's set up right now. All right, so let's see what's available for lease. All right, $15 a foot for some flex space. It looks like it's on the northeast side of town, totally different market. On the northwest side of town, we're looking at $9. It looks like, some older product, $965, $795, $10 to $10.50, $16.50, $19, $5 to $12, $9.50, $15, $9.50, $13, $8.50. I mean, I don't think that $11 a foot is off the table, but I do think that it's a little aggressive compared to what I'm seeing right here. Now, we could look at specific areas. I mean, look, the area that we're actually really looking in, the southwest corner, most of them are just rent available upon request, which to me is a bunch of brokers that don't actually want to get their space leased. It's just how I look at it. So let's say that we're not actually able to get that. Let's say that we're able to get $10 a foot though. So that puts us at, we would really actually have, if we lease that at $10 and the other one's already at 11, that puts us basically at a $10.50 blended rate. So that puts us at 105,000. All right, now let's go look at those returns. We're still cash flowing. See, it's gone down a couple points, right? Remember, it was like 7, 8, 9. Now we're at 6, 7, 7 3/4. We're still making 83% on our money. It's still a 17% annualized cash on cash return. Still not bad, right? That's still probably a deal worth doing. And keep in mind, you're taking home 30% of that, right? Let's say that we're only ever able to keep it at $9.10 a foot. So even after the lease up, let's just say we're only able to find somebody that's taking it at the same price, all right? So we will take this and we'll make it not red anymore. Oh, that's too light. There we go. All right. That means, see, our investor cash on cash returns dip substantially now. We're at 4%. So unless we're able to raise rents, this deal probably doesn't make sense. Yeah, look at that, 54% returns, which is only 11% annualized cash on cash. So not the greatest, all right? It's not necessarily a deal that I would be interested in doing. Luis is saying, do you ever advise 1031 into a commercial property where the proceeds covers the whole purchase price so there is no loan? Yeah, absolutely, but it completely depends on if you had a loan on the previous property. If you had a loan on the asset that you sold and are then having a 1031 from, you will have to replace a loan on your next property. So just keep that in mind. Luis is saying, great stuff as always. Absolutely, Luis. I appreciate that. Glad you're enjoying it. Game Master is saying, got 17 people watching and only 6 likes. Let's up that number. Yeah, come on, guys. We got 17 people watching and only 6 likes. 30 days of grinding. Simmer saying, hello from Australia. Yeah, I appreciate it, guys. Yeah, hey, if you're enjoying it, give us a like. Tell a friend. Tell a friend that, you know what, send this video to a friend that you just know sucks at underwriting and they need to get their life together. All right, so there's not a lot else that I would really stress test in this deal. I mean, it seems like a pretty straightforward deal. As long as we feel good about that market. Actually, let's go to CRE and see, because CRE has some really good data on the median days on market. Maybe we can actually dial that in a little bit. Let's get better about this. Let's go to industrial and let's go to Indianapolis. Let's see what we can pull up. All right. We'll come over here to Insights. Whoa. Why is it pulling up something in Charlotte? There's probably something in Charlotte named Indianapolis. All right, we'll look at this. You know what? I'll specifically go towards the airport submarket so that we can just get more accurate numbers. Okay, so median rate is $8 a foot. I don't love that, right? Especially considering we're trying to get 10. Median days on market, right at 6 months. Okay, well, I feel pretty good about that. And even if obviously we know we can get better than $8 a foot, but I don't necessarily feel great about 10. So I feel good about kind of where our underwriting is. So, I mean, look, from here, I would feel pretty comfortable in saying, you know what, seller, I'll make you an offer, $725,000. We'll close in 90 days. All right. See what they can do. Because anything I can get below 795, we know is just going to be icing on the cake. It's just going to really, really scream. And we like deals that work pretty well. All right. Let's see. Kevin is saying, how much in monthly distributions do you usually go for in your deals? Kevin, good question. I actually don't even look at the monthly distributions. We distribute to our investors on a quarterly basis. That way we don't have to worry too much about accounting every single month. And to me, the monthly distributions don't actually matter. My investors do not invest with me for cash flow. If they wanted cash flow, they could go invest in guys that are making far less on their commercial real estate deals, because that's what they're doing, right? They're investing strictly for cash flow. At those points, you're typically seeing like a 12% internal rate of return. Like a lot of multifamily deals today that are cash flowing, you'll get about a 12% internal rate of return for good ones. Whereas in my deals, we're looking for an 18 to 22% internal rate of return, which means that, we're adding a substantial amount of value. I'm going to double your money in 5 years, but you're not going to see any cash flow. A lot of that's going to come from the sale. So that's kind of how I go for it. Gabriel is saying, hey, Tyler, how's it going, bro? Gabriel, it's going great, man. Appreciate you joining us here. Guys, that was it for day 13. Tune in tomorrow for days 14 and 15. I am going to have to make up the fact that I had an ocular migraine yesterday. So sorry about that. My apologies. Unfortunately, not something I can control. However, we are going to be going live tomorrow at 8 a.m. Central Standard Time and 12 p.m. noon Central Standard Time, diving into whatever deals you got. So appreciate you guys for joining me. If you enjoyed this one, give me a like. Let's make Game Master happy. We don't want him getting angry. Appreciate you guys. I'll see you all tomorrow. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.